Hey guys, it's Josh Hunter with St. Fran Realty, and we are going to do another quick top 5 video installation here. This one has come, it's very important. Every time we sit down with a new group of buyers, whether that's first-time home buyer, people that haven't bought in a while, even people that buy fairly frequently, sometimes there's some questions that come up. And so we've compiled this short list, and we're going to have some of our industry professionals help answer those for us. So anyways, the very first one of the top 5 questions that we get from buyers about lending is how much money am I going to need? And this comes into down payments, what's available, closing costs, things like that. So what we're going to do is we're going to turn over to Luke Kunzelman, who's a local lender in Longmont, and have him help answer this question for us.
There are a lot of options available when it comes to down payments. VA and USDA loans have a 0 down payment requirement. FHA loans require as little as 3.5% down. There are conventional products that allow you to put as little as 3 or 5% down. Now there are benefits to putting down more money. Say if you put 20% down on a conventional loan, you will be able to avoid mortgage insurance altogether. And then of course there are down payment assistance programs out there that can actually provide you with funds for your down payment. Those programs are great, but do understand they come with a higher interest rate.
So there you go. You can see from what Luke said on there, there's a ton of different down payment options. There's even some low down and no down payment options. So just because you might not have an abundance of cash set aside doesn't necessarily disqualify you from being able to purchase a home. So anyways, the second question that we always seem to get is going to be, how long do I need to be on my job? And this can kind of go to, let's say you're switching industries, or let's say you're a server, or let's say you do temporary work. So it's a big one that comes up. People generally come in that may have just started their new career and they're really curious, how long do I need to be on my job? So we're going to go over to Martin Sullivan and have him answer this question for us.
Depending on what you do, depends on how much of a verification I have to go through to show that you continually make this kind of income. So as an example, if you're a W-2 employee, which the majority of people are, you're making hourly income or salary income or anything like that, we need to basically show 2 years of employment. That 2 years doesn't have to be at the same employer. It can be at different employers. It does help though if that employment is in the same field of work. It doesn't have to be, but it does help. It shows us that you've got some consistency and we can expect that kind of income to continue. The other red flag with that is a decrease in income. So if you went from, say, you were making $18 an hour to now making $12 an hour, we kind of want to know why. And maybe it's because you went from a job that required you to work 60 hours a week and you weren't comfortable with that, and now you're working 40 hours a week. Perfectly acceptable answer. But we want to be able to ask that question to you, and in order to know that, we've got to be able to verify 2 years worth of W-2 income. If you're self-employed, then we're going to look at a couple of different things. We're going to look at your 1099, and we're going to look at you, if you get one, and we're going to look at your tax return. Your tax return for the last 2 years will show your income from that company, typically on a Schedule C, and then we're going to average that across the 2-year period to figure out what you make on an annual and, more importantly, a monthly basis to cover a mortgage. Similar with commission-based. Now, commission-based, you're not going to be receiving a 1099 necessarily. You'll still be receiving a W-2. But if you're commission-based, we're going to look at, again, the last 2 years, and we're going to average out that income. So generally speaking, we want to look at 2 years of income. If there's any gaps in that employment, we want to know why. If there was any decrease in pay, we want to know why. But as far as your current job, you could have been there for 2 weeks. You could have been there for a month. We do want to see a pay stub from that employer, so that's usually about a 2-week time period. But overall employment, 2 years. With seasonal income and with tip income, again, we want to look at a 2-year average, and we're going to take everything that you've made over those 2 years based on your taxes, and we're going to average those out to say this is what you make on an annual basis, and then we'll break that out into a monthly basis, and then we're going to figure out what we can afford in terms of a mortgage based on that.
Well, that's some great news. As you can see, there is not necessarily flexibility with any of that, but you can kind of see that if you're a temporary worker, if you're collecting tips on there, kind of how they put that together and how they kind of run that, or if you were to switch into a new industry. So anyways, hopefully that was helpful for you guys. The third question that we usually get, and this is actually probably one of the top questions, I just happen to put it as number 3, but it was basically, will pre-qualifying or pre-approving for a mortgage affect my credit? It really seems seems to be that a lot of people are concerned when they come in. Well, I'd love to buy a house. I know this is the first step, but I don't really feel comfortable, having my credit pulled because I've heard rumors that it's going to lower your score. So we're going to go back to Martin Sullivan as he's got some comments on this particular question.
Yeah, so the most important thing to keep in mind is there's two subtle differences between pre-qualification and pre-approval. So pre-qualification is just kind of a ballpark figure, and we can just kind of talk about, this is what you make on an annual basis. This is what your liabilities are. If you know your credit score, then you can tell me that my FICO is right around this, and we can kind of come together with a real rough estimate of where you're going to fit into the spectrum of buying. Pre-approval, though, is a much more detailed process, and that's what your realtor really needs. Your realtor needs that, and the selling realtor needs that, because they're going to use that to say, this lender has looked through all of this person's finances, including pay stubs, taxes, W-2s or 1099s if you're self-employed, and we've run your credit to verify your credit score and your liabilities, and that gives us a whole picture of what your actual purchase power is. With a pre-approval letter, we actually sign it saying, I can vouch for this person that this is what they can afford. In order to do that, we do have to pull credit. And so that's where it comes back to the question of, is this going to hurt my credit score? When somebody pulls your credit to do a pre-approval, it's a very small hit on your credit score. And the reason that happens is, even though the whole process on how they verify credit is patented and it's protected, part of that equation says when somebody's getting their credit run, they're about to buy something new. They're about to put something on their credit. So that does increase their credit risk profile, but just a little, by a couple of points usually. The thing that you want to watch out for is when you've had your credit run, and then a month later you have your credit run again, and then a month later you have your credit run again, those start to stack up. But generally, if you get your credit run and then 3 days later you have somebody else run your credit, it shouldn't affect you. It should still stay at the same hit that you got the first time. So kind of a long answer to answer that question, but in general, it's a small hit, but we have to have it in order to verify that this is what you can make. And one final thing to consider with that small hit on your credit score, usually that hit is so small that it is not going to drop your credit to where you don't qualify for your mortgage. The important thing is, when you're working with me, I can get you into a loan as low as a 580 credit score. So if you're worried, maybe you're at 620, you're at 650, you're at 610, and you're like, well, if I get my credit pulled, it's going to drop me down and I'm not going to be able to get a mortgage at all. I have never had that happen to anybody. So if you're worried about getting your credit pulled because you're worried about that little hit, it's not a big enough hit to affect your mortgage payment. It's not a big enough hit to affect your rate. And more importantly, it's not a big enough hit to get you out of a mortgage, but it is required to get you on a path to home ownership.
So there you have it. Hopefully that really answered some questions for you. Like I said, it's the most common question that we get when people come in to pre-qualify or talk about pre-qualifying. They're really, really concerned about how that's going to affect their credit. So hopefully that helped rest you easy a little bit on here. We're going to go into our fourth question on here. The fourth question is, what are closing costs? That's one thing that is, kind of not talked about when you discuss a down payment. You're usually talking about 3.5% down, 5% down, 0 down, 20% down. And in our minds, that's kind of the only output of funds that we're kind of thinking about. And there are some additional funds. Basically, there are costs to obtain financing, and those are called closing costs. And so we're going to go back to Luke, and he's going to tell us a little bit more about closing costs.
Yes, closing costs are in addition to your down payment. Closing costs generally fall into one of two categories. One is either actual closing costs or prepaid items. Closing costs are the cost of getting your loan done. So these include things like your lender's fees, title fees, appraisal fees. Essentially, it's what it takes to get the loan done. Prepaids are actually monies collected on your behalf and paid by the lender. Examples of prepaid items are your first year of hazard insurance premium, a couple months worth of your taxes and insurance payments to go into set up a new escrow account, and the odd days interest, which is essentially the daily interest calculated from the day you close through the end of that calendar month. Now, the great thing about both of these items is that you can ask for the seller to pay these things. It doesn't always happen, but it is an option out there.
All right, thanks again, Luke. And now our last question, number 5 of the top 5 questions that we get from buyers about lenders is, can I borrow money or use my credit card for my earnest money or down payment? We do have some situations come up to where we do get that question where they say, hey, look, I've got this much here. I've got just this much saved up here, but I've got a credit card that's got $30,000 worth of credit on it. Or I've got a Capital One account and I've got a checkbook that came with that. Can I use that to write my down payment or my earnest money? So we're going to go back one more time to Luke Kunzelman, and he's going to go ahead and help address this question for you guys.
When it comes to borrowing money for your purchase transaction, you are allowed to borrow money as long as it is secured. So if you're borrowing money against an asset, say an existing home or property, or even an automobile, those are acceptable funds. What is never acceptable in a purchase transaction is money borrowed off of credit cards or unsecured lines of credit.
Well, there you have it. Hopefully that helps answer some questions about whether or not you can borrow money or use a line of credit or anything like that to pay for things like your earnest money, your down payment. So I hope this was helpful. This was a little bit longer video than we normally do, so thank you so much for sticking around and watching it. If you have any other requests for any of these top 5 series, we are doing quite a few of them and getting them all set up. But if there's anything that you specifically have any questions on, please feel free to go ahead and leave a comment below or contact us directly. Thanks to everybody, and you have a great rest of your day.